Okay, so Yoram, Felix, we've been chatting for quite a bit now about the European tech in a changing world order, so something that you've been presenting about for a while now, and it would be a really good time now to chat about it more in detail and go through a few ideas, I guess, that you have presented so far, and maybe ask more questions and go deeper. So would you mind taking it off?
Yeah, definitely. So yeah, I've been giving this presentation or variations of it as a keynote on a couple of events in the last few weeks. And yeah, I thought it'd be nice to present it with you to kind of wider audience. I'll just kind of walk us through it, starting kind of with the macro picture for Europe. Mm-hmm. So maybe some of you have seen this slide already. So yeah, Europe's economy has been lagging compared to the US. That's definitely true. Especially you can see that kind of since the global financial crisis, there's been this massive divergence. However, there is an asterisk literally on this slide because you need to unpack this a little bit.
Okay.
We've done a kind of breakdown, which is maybe in a kind of unconventional way, but I think a very clear way to show what's actually happening. So the vast majority of Europe's relative underperformance is caused by exchange rates, which doesn't directly affect Europe's economy on a whole. In fact, you could even argue that it has been favorable. I mean,
can you explain it to me like I'm a golden retriever? What does it mean that exchange rate in this case?
So since the global financial crisis, the euro has significantly weakened relative to the US dollar. Mm-hmm. And if we express GDP in nominal terms, if you want to compare the GDP of the US and Europe, you have to use the same exchange rate. So you typically you convert the European GDP into US dollars. And if you do that, as is the case here on the kind of on current prices, then it's massively impacted by the exchange rate. And
okay.
The whole reason that this exchange rate went down so much is actually quite interesting. It's not a coincidence that this started from the global financial crisis, because this kind of exposed the euro as a pretty fragile project, and also the way that the European Central Bank responded to it was really to preserve it, and like Europe has been trying to be like extremely fiscally conservative. There's been a lot of austerity, whereas the US, which in a way caused the global financial crisis, did the exact opposite. They came with massive stimulus, just like China. But Europe wasn't able to do that because it was fragmented. Germany was kind of there to kind of dictate the terms. If you agree with me.
Yeah, Germany was driving austerity, driving sort of the prudent mindset, the fiscal conservatism that you already mentioned. And thus, in consequence, you have a higher inflation rate in the US throughout the 2010s, but also stronger economic growth, as we will unpack. But we just wanted to make sure that you understand that the majority of the story that's being told right now is actually explained by these divergences in nominal exchange rate. Yep. And it's not only about productivity, but I think this is what we kind of want to zoom into a little bit here as a smaller but yet very important part of how to explain this.
Yeah. All right. So what you're saying is it's not that bad.
Exactly. 2/3 of the divergence is because of exchange rate movements, which are since a few weeks moving the other way around. We can get into that later. Then there is demographic differences. So the US population is growing a bit faster. Working population is growing a bit faster. Europe's working population is declining, which is perhaps a problem, although maybe in the future less of a problem if automation really takes a big leap. Then the next bucket is U.S. deficit spending. So the U.S. has been running a massive deficit, as we all know, which they're now trying to reverse, whereas Europe has been more or less fiscally conservative. We have kind of boiled this down to about $1 trillion a year in GDP growth per year. This is also something, if you fiscally spend each year, then your GDP will automatically grow faster. But that's not something. That's not something.
That's how GDP works. Yeah,
and that's not sustainable. You cannot keep doing that forever, which is why the US is now reversing that. Then you have shale. Like there was a lot of buzz on the internet where people were saying, the US economy is massively boosted by shale energy. Funnily enough, also roughly since 2008, maybe a bit later, there's been this shale boom in the US, which is like kind of an underrated story because the US has gone from being highly dependent on foreign oil and gas to being the biggest oil and gas exporter in the world, which is like kind of insane. How much has that helped their economy? So this gives you a sense. It's about $500 billion in GDP. So it's actually not massive, but it is significant. But then comes the interesting part that the Draghi report also zoomed in on. So even though it's not the majority of the difference in economic performance, it is the one that's going to compound because this one is going to stay there. All the other ones are kind of, have nothing to do with or not that much to do with economic vibrancy and economic strength, but the red one, productivity growth, is really about how advanced is your economy, and that's going to compound, and that's going to cause the European economy, if it stays like that, to fall behind and continue to fall behind. And like Mario Draghi said, at some point you cannot uphold your values anymore because you're too far behind. So that's the
because
thing.
This $1.5 trillion is the difference between Europe and the US. Or is it an absolute number?
It is, So if I go now to the next slide, so here you can see the divergence of GDP per hours worked. That's what productivity measures. So that's causing a difference in GDP growth. And over the last, so here we've converted it to $1.5 trillion since 2008. But if you measure it as a percentage, it's about I believe it's about 0.5% of annual growth. And that sounds like almost nothing, but over many years, that is a lot.
Yeah. And it's actually going down.
Yeah, so
for Europe,
exactly. You see, especially in the last few years, productivity has really flatlined. If you would show the UK on this, it would look even worse. There are some countries that are doing quite well, like Poland. The Netherlands used to be ahead of the US in terms of productivity, but has fallen below it.
What happened?
Yeah, so the thing with productivity data is that nobody is exactly sure why it happens. But the Draghi report made a convincing case that tech is part of it, regulation is also part of it. Yeah, some people would say that Europe has actually been deliberately slowing down growth because it had other priorities. It wanted to be the best in fiscal responsibility, wanted to be the best in lots of other things, and actually didn't have growth as the top priority.
And now in the hindsight, was it the right decision then, from your point of view?
From my point of view, definitely not. And I think this is now starting to be more accepted, and there's more popular support for actually having a growth mindset, especially in today's environment. Suddenly, it turns out that not focusing on growth was kind of maybe one of those luxury beliefs.
I kind of want to jump in there and challenge that a little bit, because I do think that at the time it was necessary. It was necessary to preserve the European project. It was necessary to preserve the euro, if that is something that we sort of had an interest in keeping. But I think that's sort of not necessarily the question that is important to me right now. I think we should have more of a reality check, where it's not like, should we have done this in 2008 to 2013, but rather, where do we stand now? Do we need to reevaluate our priorities? And I think this is sort of what we're seeing, that fiscal responsibility, we're understanding now, like on the merits we can discuss a long time over the last 10 years, but we've come to the conclusion that today we need something else. And today we need more investment. And I think that is sort of the conclusion of all of this for me, which, I would call it a reality check.
Like one of the symptoms of not focusing on growth is very visible in the stock market and wealth creation.
That's a pretty damning chart.
This is pretty damning for Europe. What it also shows is that the U.S. economy, as the title says, is way more tilted towards VC-backed technology. In the U.S., 2/3 of the stock exchange is value created by VC-backed companies, so Microsoft, Google, the Magnificent Seven, but also a whole host of companies below that. Whereas the European stock exchange is mainly dominated by incumbents that are more trying to kind of preserve the status quo, and that's what you see here.
And it's not even moving all that much over time.
Well, especially relative to the US, it is not moving. If you look at Europe as standalone, there's a bit of value creation, but not that much.
Right. Yeah, that's a pretty big difference. So, and what does it mean?
This is a symptom. This is not maybe a goal in itself to have a high-performing stock market, although it does have repercussions also for pension funds and for savers, for example. And it creates this kind of negative cycle where people are less inclined to invest long-term in European companies because the returns are also not that attractive. So that's something that has to be broken through. But there is, I think, an even bigger reason why European tech is important, because we've now, as this slide here shows, have become super dependent on US tech. So here we kind of broke it down into like compute layer, foundational layer, application layer. So we kind of stole the AI framework, but actually thought, this is universally applicable to tech in general.
It is.
You always have those layers. And especially on the application layer, like we all know our lives are being run by almost all US-built applications. Google, Facebook, the browsers we use, where we watch our TV shows, where we're maybe going to watch this podcast episode. One funny exception are drones. So 70% of all drones are manufactured by one Chinese company. You could also add defense on this, that's obviously not good if we're so dependent on US tech. If you go to the foundational layer, things like Visa, MasterCard, the operating systems we use, the foundational AI that we use, where we host our software, is completely US dominated. And there are some exceptions. So Linux, which is still like the dominant server operating system, is built in Europe. Yes, it's an open source effort, so there's not a lot of money being made directly, but still.
Is Europe where the foundation itself based? Like how do you pin down the location of Linux headquarters, which don't exist?
Well, it's now distributed basically, and it's now maybe no longer European, but at least it was developed in Europe.
Yeah, that's true.
And I think the argument, we should do a whole episode on open source, actually, because
I'll be very happy to.
Because the argument for open source is also stronger than ever. Yeah, and then on the compute layer, there's ARM and ASML. But in general,
it's the most diverse part, it seems, actually. We have 4 lines, each with a different flag.
Yeah, pretty much. And although, interestingly, like ARM is now 90% owned by SoftBank.
Yeah, okay, that's... but still not the US.
Yeah. No, true. This is another reason why being kind of 30 years late with developing a strong tech sector has now kind of biting us in the backside.
That's a good way to sort of explain it. But as far as I remember, actually the point of this presentation was to talk about how things are not that bad, wasn't it? But so far it's been pretty not great.
Yeah, that part is coming later.
Oh, okay.
So this is a screenshot from another YouTube channel, EU Made Simple.
Yeah. I see the logo.
Yeah, they make pretty nice videos, in my opinion, and I thought this was really striking. So yeah, it shows that Europe is exports goods to the US, which is what Trump doesn't like. But it imports services, including financial services, but there's also Google and Meta in there, OpenAI.
So all those lines from the previous slide,
exactly.
they're all here in this red part.
To a large extent, yes. Also, I think a lot of these, like AWS, Google, Microsoft, have also massive operations within Europe, so that wouldn't count as actually importing services.
So if we were to count them, this number would have been much larger.
Yeah, it would have been even larger because, even Microsoft's operations in Europe, massive profits are being made on it, and those profits, do go also to U.S. Shareholders. So this is actually understating it. And you can see this red line, the trend is down. I would expect that with this new AI wave, where the U.S. is massively leading, if we hadn't done any of this tariff nonsense, the red line probably would have further gone down. That's and the whole trade balance thing would have solved itself already. But now, with this kind of protectionist world that we're now into, I think, Europe is going to take a closer look at the red part and maybe not impose tariffs. I think that would be really bad. But think harder and have a lot more sense of urgency that we need to build a stronger European tech sector and financial sector by the looks of it.
Right. But again, that's not something that's done quickly. That will still take, at least 5 years, I would say a decade.
Yeah, no, absolutely. Decades. But at least I think this will help us get priorities straight.
Right. Yeah, that makes sense.
Yeah, so the world is changing, clearly. And this brings us to like a kind of last, maybe segue to where it becomes more positive. So the funny thing in Europe, and like Felix can also speak to this, so Europe has been operating, as you can see on the left, below its capacity. In Germany, like a lot of factories are empty. The German way has been kind of to keep its economy from overheating. That was the worry, and like low inflation, very fiscally responsible, didn't invest a whole lot, keeping prices low, keeping wages low, and as a result, the southern part of Europe have been relatively less competitive. And that kind of kept Europe in a stalemate, not operating, at full capacity or below its potential. Now, Germany has really made a total U-turn, where they are much more inclined to invest in infrastructure, invest in their tech sector, remove bureaucracy, invest in their defense. That should also mean that wages can finally increase, which is good for overall consumption levels, and it makes the South more competitive. So you kind of get a positive cycle between the North and the South, where, for example, northern countries can purchase manufactured equipment from the South. And Italy, for example, is actually really a strong manufacturing country, and hopefully that now comes more alive.
And this capacity utilization graph, you think, is going back up then? if Germany is increasing sort of the intensity of its economy in that industry.
Yeah, if they actually do what they are saying they want to do, and I believe the military pressure is so real. The need for an energy transition is also massive because like Europe used to import gas from Russia, as we all know. Now it's importing gas from the US. Like, what if Trump decides no more to stop exporting gas? Like, so the pressure is real. So it is really urgent that Europe makes these investments. And as the title says, like, pressure makes diamonds. This is actually what Europe needed. And I think some economists have been saying this for years, that this needed to happen, minus the military part. But that's maybe the last push needed.
So you're saying now is the moment.
Yes.
Germany is in a very tricky position. If the Southern European economies become more competitive, sort of the core of the German economy, like the industrial base, which is now more and more leveraged towards sort of the defense effort, they have traditionally built a lot of cars. They face immense competition from China. They now face tariffs on sort of that industrial base coming from the US, and sort of facing more pressure from more competitive Southern economies is actually, to me, it really remains to be seen if this will be a transition that Germany can master. And yes, we see a lot more investment efforts, but the way that the German economy is structured sort of really builds around a strong manufacturing base, a strong industrial core, and then building the service industries on top of that. I think a lot of that needs to change, and that might potentially be quite a painful transition.
And that brings us to the good part. I'm just waiting for the good part.
Well, we'll get there.
So yeah, now we get into European venture and innovation, which is maybe a little bit more our comfort zone.
And how big a role is it going to play in this whole transition?
Yeah, that's a really interesting question, actually. I think there is a massive role also for energy and manufacturing, actually. And the good news is that Europe is actually really good in manufacturing, and it has to invest in energy. But there is definitely also a big role for tech and innovation. Europe has been going through an evolution also already over the last 30 years. So Dealroom data shows that Europe has produced over 1,000 VC-backed tech champions, which we here have defined as a company that's either become a unicorn, so worth over $1 billion, or
US dollars.
Yeah. Yes. Or $100 million US dollars in revenue, which we call thoroughbreds. So you have kind of the unicorn, which is a mythical creature, and the thoroughbred, which is an actual real life creature. Both have value. Unicorns, that's more kind of looks at future potential, but we also increasingly want to look at fundamentals. Especially because if you only look at unicorns, I think it's very reasonable for people to question, like, okay, but are these companies actually, what are their fundamentals? Yeah. In practice, it turns out that most unicorns are really strong startups and very successful startups. The whole narrative around zombiecorns is a bit exaggerated. But of course, there are some, and that's why it's good to also look at fundamentals.
And how do we know the revenue numbers, just to understand as well, if they're not public, that is?
In Europe, also private companies generally need to file their financials, and especially in the Nordics and in Europe or in the UK and in the Netherlands, that happens. In some other countries, it's a bit more difficult to find, but increasingly we see that it's become a badge of honor to show how much money you're making. And now all these AI companies are also like proudly sharing how much revenue they're making. So that's a good trend. So yeah, we've spent at Dealroom a lot of time collecting revenue data, and we have now a pretty good view. And I believe over 80% of VC-backed startups have now the financial statements.
Is it a good number? 1,000 champions.
I will get to that in a second,
Okay,
actually.
okay.
That's a good question. I mean, but it is a good number in the sense that what you're hearing from people like Niklas Zenstrom and Harry Nellis from Accel, they said like when they started in VC in Europe, like 20 years ago, people were questioning if Europe could even create one of these companies, and now we have 1,000. So it shows there's been a massive evolution. The other thing that I think is a positive is that 3.5 trillion in value has been created by European VC-backed companies. And you can see that here by cohort and rapidly going up. And so 3.5 trillion, it sounds like a lot. So how much is that? So we compare it here with the European stock market. So the entire European stock market, so we take the Euro Stoxx 600, it has increased by about 3.7 trillion since the global financial crisis. So that chart earlier where you could see Europe being kind of flat, it did actually go up a bit. It created almost 4 trillion in value. So the VC-backed startup ecosystem has created 3.5 trillion. And then mind you that's been with only about 3 million people, whereas the entire European stock market is a much bigger part of the economy with almost 60 million workers, 58 million workers.
So it's much more effective in creating value.
Yeah, it's a lot more productive. And yeah, we were discussing just a moment ago, why is that? And I think one of the key factors is that these kind of big incumbents are generally just more focused on like maintaining the status quo than really taking risk and being disruptive, which is what you're seeing more of in the US.
I guess also many of the incumbents are just because of their business model and what it is that they're doing, they're a bit less scalable than many of VC-backed companies that should be scalable by definition.
Exactly. Yeah, I would say tech is almost by definition like it's a better, more productive way of doing things.
Which is why we are all in tech, one way or the other.
Yeah. Everyone has probably seen this bubble chart millions of times. It's good, and I think it was a good wake-up call for many people. So it was also used by a lot of people in the US to
do some Europe bashing.
Yeah, to beat Europe on the head, which I found a little bit weird actually. Like I think if you are already doing so well, why do you? I actually think this is a sign of
but I think it became a very popular sport on LinkedIn at some point.
Yeah. And that was one of the triggers for us to actually do this report. But I think the real story is more nuanced. Because if you look on this bubble chart, you see the big bubbles are Apple, Google, Meta, Microsoft, NVIDIA, Oracle. We think of those as relatively young companies, but they are already quite old. Most of them were created in the 90s or even before. Meta has been created, I think, in 2004 or something like that. So these
7, I think. Well, Facebook, that is.
Yeah. So these companies were created in a time when a digital revolution was happening and Europe wasn't really a major part of it. It also didn't have a VC industry. Whereas in the US, they already had a significant VC industry back then. A lot of people had made money in the semiconductor revolution, which Europe also didn't fully participate in, with some exceptions like ARM and ASML and a few others, obviously. So Europe's VC sector was almost non-existent at that time. But since then, it has started also in Europe. So this chart kind of shows it. You can see companies like Intel, Oracle, Microsoft are from an era where Europe really didn't participate. Then in the 1990s, that's when Amazon, NVIDIA, and Google were founded, which you see that European VC-backed tech started to evolve somewhat. But as of today, if you look at companies created between 2020 and 2025, so in the last 5 years, European startups produce 17% of the enterprise value, which is roughly Europe's GDP. So I always, I really love this chart, and I think it shows that Europe is catching up, despite what it may look like, because those very, very big companies, thanks to power laws and thanks to globalization, actually, those big companies like Amazon have been able to become massive businesses, and they become bigger and bigger. So it's a bit like an expanding universe. Like the things that are furthest away are moving the fastest also. But maybe now the universe may be contracting,
shrinking
again.
a little bit, yeah.
And I think it shows that Europe is actually catching up. That's the bottom line.
Even though right now, what you're saying is it's harder, for example, for a European startup to compete with the bigger ones, the older ones, but it's still catching up, which basically means that the momentum is actually even stronger than it would have been if these numbers were shown, let's say, like 20 years ago.
I would say the momentum is strong, but we also have to keep in mind that these sort of 17% of the youngest companies, these are all sort of new startups. These are smaller companies. These are not necessarily scaled to the same global level as we maybe see in some of those older cohorts. So I think it remains to be seen a little bit if we can really build these champions in Europe. So we have a very, very strong momentum, if you want to call it that, but that doesn't necessarily sort of predict the future of being able to build successful businesses like the sort of mega corporates that
like
the US has
category leaders,
created.
basically.
Exactly. And this is sort of what we should probably strive for.
For example, in 2010, in this cohort 2010 to 2019, I think that's where Adyen was founded, and Revolut and a couple of those other companies. Yeah, and they are category leaders, even though they're not trillion-dollar companies yet, but they could be. Like Adyen and Stripe are kind of head-to-head, which is totally different than Google, which was uncontested. So that's an evolution. But yeah, like Felix is right that the question is, can this younger generation of companies really scale to become very, very large companies?
Right. But we're already seeing that there are fewer monopoly situations than for the US
and maybe
companies.
sort of in the more fragmented world that we were sort of touching upon earlier, you don't necessarily need these one big category leader, but rather there can be a lot of smaller champions that will still be very successful. So I think that's actually a very interesting point to keep in mind for how we think about this going forward.
Yeah, I agreed. So I think it often triggers the question like, okay, do we actually want these trillion-plus companies? To me, I wonder maybe you have a different view on this actually.
Let's see.
But what this shows is, so 0.01% of companies create 40% of all economic value. 0.3% of companies create 2/3 of the value. That's the whole kind of purple part. So what this implies is, and if you want to be relevant, you do need to create those trillion-dollar-plus companies, because in the age of tech, things are very distributed. It's often, even if it's not a winner takes all, it's like kind of oligopolistic by nature technology, I think, while also being constantly disrupted. So in that sense, realistically, I think you would need to create very large companies to be relevant, unless the whole world becomes way more fragmented. But that's personally I hope that does not happen. And I think that if you look at those companies like Google and Tesla, Meta, NVIDIA, they are very powerful, but they are not really monopolistic companies, in my opinion. Like Google is now getting disrupted by OpenAI. Meta was getting disrupted by TikTok before it got banned. So they are not monopolies in the old sense. Like that doesn't, they can abuse their power, and sometimes you need to intervene, but they are not like monopolies like
not all. Well, Nvidia is quite significant in its own niche, which is becoming more and more important.
But people want to buy their product because it's the best. It's I think a monopoly is where something is kind of shoved down your throat and you don't have other options.
Yeah, I think sort of the Nvidia argument is CUDA, but I think just by the margins that Nvidia is making, there are so many challenges to them now that it is quite unlikely that sort of the dominant position that Nvidia is holding today will hold going forward. I mean, it remains to be seen, but at least I imagine there will be a lot of people going after those fat margins that are existing currently. But I actually wanted to zoom into something else here a little bit. So we were saying, okay, 40% of all economic value is being created by these gigantic companies. And this is sort of something that I wanted to touch upon a little bit when we were looking at the sort of divergence of the stock indices earlier, because it is not just about, okay, do the shareholders make a lot of money, but it is also about the ecosystems that this creates. Like we at Dealroom, we think a lot about, so we put a lot of value on unicorns, for one, because they're interesting to think about, but also because they have a very strong sort of mafia effect and also financing effect within an ecosystem. They create a lot of talent, they create a lot of new companies, but they also invest very dramatically in other companies, new technologies and research. And I think that is really something that is also driven by their access to capital. By having these gigantic valuations, they're just able to raise a lot more money, attract the best researchers, attract the best talent. And in that sense, they are also really driving innovation outside of just their own corporate structures. And I think this is something that we don't necessarily have in Europe. We don't have financial markets that are as mature. We don't have sort of the same capital availability. And I think this is something where we sort of lose ourselves a little bit in describing economic value in terms of the enterprise value of these companies. Like it's very nice to see, and we're always talking about the stock market and all, but I think that is also cutting a little bit short what this actually means for the companies themselves that are trading at these valuations.
No, I agree with that. Like these are imperfect ways to measure the thing that it's actually about. Yeah. But
it has a gigantic effect, and I'm not quite sure if we sort of have it in this deck. But I remember us talking about sort of the financing impact that these Magnificent Seven, as we call them, have compared to Europe at large, and I think that is quite striking to me, and driven by the ability to access capital in a way that European companies aren't.
Yeah, totally. If you look at kind of frontier R&D, so that's R&D that's being done by tech companies, this is completely now dominated by these big U.S. tech companies.
Oh yeah, I think I saw this slide. So is it more than the entirety of European investment, or a little bit less? But comparable.
I mean, like the Magnificent Sevens. If you look at their capex and R&D, it's like $500 billion a year or something like that. That's more than all the venture capital invested in the whole world, something like that.
That's getting closer to the 800 billion from Draghi report.
Well, I mean, 800 billion is still a lot of money, and that's every year. Yeah. So we can talk about that another time. Yeah, there was one other point I wanted to make here. So here you can see kind of the graduation rates of US versus European startups. So it shows, so there are about 3,500 new startups raised VC for the first time in the US every year. So that's kind of the rate of entrepreneurialism. And in Europe, the number of startups is almost similar, so 3,000. But then the conversion from startups to breakouts, which we define as companies that raise more than 15 million, so kind of Series B and up, is a lot lower. And this conversion stays lower throughout the funnel. And why is that? That has probably to do with fragmentation and maybe lack of capital and other things we get to later. But I think coming back to this new world order, fragmentation, tariffs, protectionism, I think, if you're in the venture business, it's all about outliers. So you only care about those 0.0 something percent of companies, those actually matter the most, or even just the top 1%.
Yeah.
I think the chance now that Europe is going to build very large tech companies and more of them has gone way up. Even though I think a world that's more fragmented is on a whole bad for consumers and bad for everybody, I think in terms of outliers, the probability of building big outliers, even if it's 100 billion plus companies, 10 billion plus companies, that probability has gone up.
Just through the sheer sentiment change?
Yeah, exactly. And there will be a lot more support. And just like maybe, the airline industry and the car industry got a lot of support in the past. I think it's likely that, one way or another, tech companies will get, even if they don't get direct support, they will be helped with deregulation and in other more subtle ways.
I also feel like at least part of this chart at the left-hand side is also about the sheer size of rounds in the US and Europe. Is just because just much more startups are able to raise those $15 million in the US in their still being relatively early than in Europe. So I guess if we were to correct a little bit, to apply a sort of coefficient to the European side of this, the difference wouldn't have been that big, at least in this first 2 steps or so.
Yeah, so this is a kind of hotly contested topic. Some people feel like, okay, obviously we are undercapitalizing our startups, because you can see here we're just as entrepreneurial. Mm-hmm. There's far less breakout and growth stage capital, so no wonder that we have fewer of those companies. Others are saying, no, that's not true. If you look at Europe's most successful startups, they don't have any problem raising money, which is also true. But I think you need a bit of abundance. That's like the nature of venture capital. And secondly, we'll get to that later, but most of the capital that these startups raise comes from the US or from Asia. So that means that the most successful European startups end up with investors that are all non-European. Mm-hmm. And so we're literally by design ending up with none of our most successful startups.
Yeah, okay.
Exaggerating it.
Fair point. Yeah.
The good news is, of course, this founder snowball effect that I think Atomico did a good job in showing that, especially around Skype. We've also done a lot of work at Dealroom with Axel, and the bottom line is there's the kind of current cohort of entrepreneurs is the largest ever, and has more experience in building big tech companies than ever before. We talked before about those 1,000 successful startups. At each of those, there have been hundreds of people that have been able to see from within how to do that, and many of them start their own companies. And have bigger ambitions. And that's totally different than 10, 20 years ago.
Yeah, and this is something that happened in the US earlier.
Yeah, exactly. That happened in the 70s and 80s and 90s in the US.
Mm-hmm. That was a long time ago.
Yeah.
That has a lot of time to catch up to.
I was just literally thinking that, the 70s were 55 years ago, guys. It's not a nice thought.
Yeah,
definitely not.
Now we're going kind of in this new era. So there was the PC era where, Europe did create ARM, Linux, ASML. Yeah, the internet era where, especially in the beginning of that, Europe was nowhere to be seen. No, not nowhere, but you had Skype and maybe some antivirus companies. Yeah. But then came kind of Spotify, Booking, Adyen, Revolut, where it really produced champions. And that's where we produced a lot of the world's enterprise value, actually. But now we're going into this whole new era where like the game is again completely changing, and where Europe potentially could also do really well. If you look at deep tech, things like quantum, grid technology, water tech, AI drug discovery, you have, of course, isomorphic labs being built out of Europe. Europe has a lot of talent and a lot of scientific talent. So could do really well here. That's what we're kind of arguing.
I have to say that I've been hearing this for at least 10 years now.
Yeah,
I mean, it's still true. I'm not saying it's not true. Europe does have a lot of talent, and especially scientific talent, and the research is our strong side and everything. But how is this time different?
It is an evolution, and I think the culture is slowly changing. I remember talking to a relative of mine about spin-outs and what are university spin-outs. And they were like, so this is to make money from a scientific discovery,
as if it was like a bad thing.
As if it's a bad thing. So I think that's still very pervasive, but that is changing. And I think, if you look at, for example, France, the culture has totally changed in the last 10, 20 years. You will see the same at the universities. That's it is directionally definitely happening.
And also, France has done a lot of work, consciously working on this change, I think.
Do you think it was a conscious effort?
Well, to me, it feels like it was with the initiatives like La French Tech, which is a bit more recent, but still, and with the policies of the past maybe like 5-7 years. It's changed a lot, because like 10, 15 years ago, as far as I remember, at least like from my point of view, France was seen as one of the least entrepreneurial countries in Europe, and now it is totally different. And I think it is not a result of just like random changes that somehow happened to be successful, but this was, I think, policy decisions.
Yeah. Probably that, and also some people setting the right example, like Xavier Niel. We also recently published our Q1 investment report, which showed like the top categories in Europe when it comes to European tech investing in the last quarter. So Q1, AI drug discovery.
List.
Yeah, industrial tech, which is going to be massive. That's been kind of like a sleeping giant that's awakening, we call it. Like that's also been already talked about for 30 years about kind of digitizing our factories, but
is this what we used to call Industry 4.0?
Exactly. Yeah.
Okay. We're done with numbers.
Done with numbers. So just to kind of take it to where to go next. So how to win in European tech. We have our little prop here, EU Inc., which is being like really embraced by everyone. We'll see if it's not going to be the silver bullet, obviously, but it's about making changes, and I think the direction of it is good. So it's all about like removing hurdles that are unique to European startups. So university tech transfer, setting up your company, KYC, GDPR, labor laws, all those things. Like you have working against you, I think, as a European entrepreneur. But on all those things, changes are being made because people are increasingly aware that those things are hurting our economy long term. But despite those hurdles, Dealroom data has shown that European founders produce unicorns at the same rate as US companies per amount raised. Mm-hmm.
I'm just trying to understand how this is different from the chart where we saw the difference in the funnel, like how.
So how do they work together? So actually, there's also Atomico showed that the conversion rate also of European startups is roughly the same as in the US, but US companies tend to raise bigger rounds at every next stage. And so if you just measure like, okay, first round, second, third, fourth, fifth, those graduation rates in the US and Europe are roughly similar, but then US companies tend to raise much bigger rounds, especially at the later stages. And so what we showed earlier was kind of standardized by the amount raised, and then you still see a big difference.
I see.
And then here you see that if a US and a European company raise the same amount, the probability that they reach unicorn status is the same.
Okay, that's an interesting point. So, and do you think that this is the best sort of way to measure it? This is the best way to compare the ecosystems?
I think it gets a story across. It gets a point across. I think the reality is more nuanced than this. Yeah.
Okay, so but at least we're definitely in the good news territory.
It's kind of a glass half full way to look at things. The total amount of funding, we have to also here look back, like what happened in the last kind of 15 years. There has been a massive increase in the availability of startup capital and breakout capital. Yeah, of course, there's been a massive bubble, which we're now kind of back to normalcy, and the trend over the long run is definitely up. But the issue is still at the scale up stage. So US, there is like in 2024, 120 billion invested in scale ups, and only 18 billion in European scale ups. So that's like an eight times difference. Then, back to the earlier point. So some people are saying, okay, but European startups that are successful don't have a problem raising scale-up capital. Maybe true, but then the other issue is here. So here you can see the percentage of that capital that comes from domestic funds. And this basically shows that like European scale-ups raise only a quarter of their capital from
locally.
Yeah, locally, and 3/4 non-locally.
While in the US, the number it's totally the other way around.
Exactly.
It's just inverted.
Yeah.
But does it mean that there is not enough capital available, or does it mean that you get like better terms, or there are other reasons for this difference?
There's not enough European scale-up capital, and it's not a problem for startups, because for them it can be fine to raise money from a US fund, but it is a problem for Europe on a whole.
Right. Do you mean, is that because just the money is basically gone out of the system?
Yeah, it's a huge leak in the system, and we have created now 100 billion plus tech companies. So ARM is owned by SoftBank. Booking is owned by Priceline because they also couldn't raise. They are from an earlier time when we also didn't have startup capital. Now we have startup capital, but we don't have scale-up capital. And then Spotify, I think, was able to raise from a number of European funds earlier in its journey, but also those later rounds were all US rounds, and then of course it had to IPO in the US.
And I mean, this is the topic that I think also gets discussed very often. Like, where do we get more money for European startups, for European scale-ups? The answer has always been pension funds, savings, and everything else. But it's sort of yet to materialize. And I was just writing in my newsletter the other week as well that there is this new initiative, right? This Savings and Investments Union that was announced by the European Commission. So maybe this time it is actually more serious. Maybe this time it will actually happen, and we will get to this abundance that you mentioned before.
Yeah, although you of course also want those savings to be successfully invested.
I mean, we're still talking about like 0.1% or something like that.
Exactly. Yeah, it's still a fraction.
It's not like you're allocating half of your pension savings in a venture capital fund.
100%. Exactly. But it is really important, I think, that with those reforms, that we really speed up also these kind of reforms, because that's like the key to unlock that value growth, and then at the same time make more capital available. So they both have to happen in tandem. Yeah. So here you can see there is more domestic VCs starting to raise more money, and just a last kind of point that I think gets not enough attention. It is like VC is like they call it an access class. Only the top 1% actually produce positive returns. So when you are investing government money or pension money, like we have to make sure that it goes to the right capital allocators. I think we have to take a critical look if there's too many regional government-funded initiatives that start to invest directly. Like, why would the best, the most successful startups raise from a local government fund? So you have this adverse selection problem, actually. I think investing through fund of funds and making sure that the money in the end is allocated by investors with a proven track record is pretty important. And maybe you want to leave some room also for new entrants, but that I think the majority of the capital has to go through to allocators with a proven track record.
Mm-hmm. I think this is what the European Commission is doing, what the EIC is doing now, right? In the EIC or with the trusted EIC fund, with the trusted investor network, for example, you can say that it's a similar approach.
Yeah. And EIF as well.
EIC is more like a co-investing approach, and yes, EIF is where the actual money is.
Yeah.
So the fund of funds model is roughly how public money was flowing into European VC so far. So this is roughly how we've done it, since the sort of policy officials don't necessarily have the access that you need, as Yoram was saying, and this way you can give the capital to the best capital allocators, and not necessarily by deciding who gets the money from a policy perspective.
Right.
And so there is this saying, government shouldn't pick winners, and that's true. So they shouldn't pick winners in terms of investing, but they should probably, at least pick
the pickers.
They should pick the winning pickers. Yeah, exactly.
No, that's a good point. But again, you were saying, Felix, that this is actually how it's already been anyway.
Yeah, roughly at least structured through the EIF, and we've done a lot of work on this recently, also with the European Commission. And there is a push to do more direct capital allocation from the European side. But I think I sort of stand with Yoram on this quite a bit, that the fund of funds model is actually a very sensible way to do this, and a very sensible way to sort of distribute expertise along sort of the channel of financial intermediaries. And it doesn't hurt to have some more sort of strategic priority investment, and especially infrastructure investment, where you need a little bit more industrial policy and a little bit more sort of public money that is a little bit more long term than what VC can produce. But I think we sort of need to be nuanced, and we don't necessarily just need to advocate for a stronger stance of public institutions, be that the EU or national governments in venture capital and in startup creation, but rather know, where do we need risk capital? Where do we need long-term sort of infrastructure building? And I think those are the questions that we need to answer.
Mm-hmm. Right. So where does it all bring us to?
That's a good question. Is that the conclusion?
What is it supposed to mean?
We have to send more rockets into space.
ESR Aerospace has just tried.
Yes.
No, there is a vibe shift. I think people were very, very enthusiastic about this launch, even if it failed. I think people started to understand this concept of if you try hard things, you don't always succeed. And I think that ISAR managed to actually get funding for at least 3 launches, because they knew, like, the first ones, like won't succeed. SpaceX needed 4 launches to get into space. I think ISAR wants to do it in 3. But yeah, that's a whole mindset shift. But also, if you now look at the general tone of voice of policymakers, they're really into this, and I think Europe is maybe now, very much aligned in that this needs to happen. And I saw a few weeks ago some news around GDPR that within months they want to make this much lighter.
I saw the headlines. It was really surprising. I didn't see that coming, to be honest.
Well, no, exactly, and so that's a huge shift. And I'm personally in favor of changes like that. I think regulation that penalizes people with good behavior is generally to be avoided. You want to focus on people with actually bad intentions and not burden everyone else.
I see what you mean.
Which is, and I think coming back to tariffs, to me, tariffs are like the ultimate intrusive regulation and tax bundled into one. It's very heavy-handed. It's very burdensome. It slows down everything, and so I think it's funny that's now happening, being initiated from the U.S. and that suddenly Europe is a lot more forward thinking.
Yeah, so for once, it actually might be a good thing for us, or is it still not a good thing? So
it's still overall not a good thing, and I think there's a chance of global recession, everything, so that's bad for everyone. But I think it is also kind of the pressure that Europe needs. It creates more sense of urgency. So I don't want to say it's a good thing by itself, but I think it just highlights even more the importance of being a very entrepreneurial continent.
Yeah. It's also a good timing that the Commission is relatively fresh and we won't have any new elections anytime soon on the European level.
Yeah, so I think what it boils down to for me personally is we've presented a lot of data that's explaining that the conditions are changing. And I think this is not necessarily going to sort of force these new companies into being. It's not going to automatically create these economic outcomes that we're interested in. But I think creating the conditions is the sort of right way we should think about it. It's supposed to make it imaginable. It's supposed to make it possible for the current entrepreneurs, but also the entrepreneurs of the future to build these kind of companies and create these sort of economic outcomes in Europe for Europe and not necessarily just sort of as being adjacent to the US. And I think there's a lot of sort of very good momentum. And I think momentum is also something that we focused on here a lot. And we're not here to predict the future, I think, but we want to sort of.
We can very well try.
Yeah, exactly. But I think it's good to be. I think it's good to be hopeful, and I think it's good to. I feel like in Europe we're very often stuck in these sort of. Doomer discourses, and we look ourselves in a very bad light, and we're always sort of in the strict comparison with the US. But I think we should also be appreciative of, for one, sort of what we've achieved in Europe over the last 10 years, the talent that we have here, and also the opportunity that lies before us and the conditions that are being created to grasp the opportunity. Sort of maybe I want to end on that hopeful note. We can always go into more detail on further questions, but that's my personal sentiment. Exactly.
Perfect. So this is a great way to wrap it up. So Yoram, any last words then from you?
No, I agree. Like we should definitely look at the last 10 years and actually also the last 70 years. Like Europe as a project, like after the Second World War, it was completely in tatters, and now it's like one of the most successful democracies in the world and a great place to live. And that was not a given just like a couple of decades ago.
Absolutely. Now, Yoram, Felix, thank you so much. So we will be back at this table hopefully soon to dive deeper into some aspects of it. But for now, thanks a million. Pleasure talking to you.
Absolutely.
Likewise.
Thank you.